Shan, just to get a bit of a pulse check after such a volatile and tumultuous year, how are you feeling about the world? Are you positive, negative, concerned? How are you feeling? What's your sentiment?
I think I feel much better today than before the end of the year. I think this year is better than last year, I think in two ways. Now we know that we have vaccines, so hopefully that would turn the pandemic around. The second thing is we no longer have Trump, so the world should be much more stable. So I'm cautiously more optimistic about 2021 than 2020 at this time. But I think that for all the major economies to turn around, we'll have to wait until probably the second half, because I don't think that a large enough population will be vaccinated before summer.
I see. So in terms of the way you are positioning your investments in Asia, what are some opportunities in the region? What have been keeping you busy?
Last year, PAG as a firm, which manages about $40 billion in capital, invested altogether about $8 billion. We also realized about $5 billion. So it was a very busy year for us. And the largest market for us, especially last year, was China, where the pandemic is very much under control. And the economy dropped, as you know, about 6.8% from the previous year in the first quarter. But starting from the second quarter, it has recovered fairly strongly. In the second quarter, GDP went up 3.2% from the previous year. Third quarter, it was 4.9%. The last quarter number is not out yet, but I think the street consensus is going to be about 5.5%. So for the full year, Chinese economy probably grew about 2 years. But that actually disguises the on-the-ground activities in China, because there's no longer a lockdown by and large, and people travel freely, and our team can meet with people freely, and therefore our deal activity is very high. And I would expect that to continue this year.
Is there any particular segment or sector that you are focusing on?
Yes. I might add, last year we didn't just invest in China. We did a couple of deals in India. We did a couple of deals in Australia. So we are active throughout Asia. One advantage that we have is we have teams on the ground in each of the major markets. We have offices in Shanghai, in Seoul, in Tokyo, in Singapore, in Sydney, in Mumbai. So all these major markets, we have teams on the ground. Therefore, even though it's not possible to travel across borders nowadays, our teams can be active on the ground in their respective markets. Our strategies for different markets are actually very different. For example, for China, we stay away from export sector. The reason is the Chinese currency, as you know, has been appreciating. RMB appreciated about 6%, more than 6% last year. Labor cost has been going up a double-digit level every year in the past 10 years. So the cost of input have been going up for the export sector. Another problem with China is China has driven economic growth through investments. And there has been so much investments that there is a problem of overcapacity which tends to depress the prices of finished products. So for the export sector, you have rising costs, then you have flat or even falling prices, and therefore the profit margin is squeezed very thin. So China is shifting its growth model away from exports in the direction of private consumption, which remains a very small percentage of GDP. I think by the end of 2019, private consumption to GDP ratio was 39%. That was up from 35% 5 years earlier. Now that compares with 69%, 68% for the United States, and 63% for the world average. So China has underconsumed. The private consumption has been too low. And China's growth model, driven by investment, is not sustainable because the Chinese population is aging, savings rate will drop, and therefore investment rate will drop. So China will have to shift its growth model away from investments to private consumption, and there's a lot of room to grow. I just mentioned that in the past 5 years, private consumption has increased from about 35% to 39% of GDP, which is still much lower than the world average. But if you look at China's retail goods market, 10 years ago, it was $1.8 trillion in 2009. Americans' retail goods market in 2009 was $4 trillion, more than twice that of China's. In 2019, China's retail goods market was $6 trillion. America's was $5.5 trillion. And last year, I expect that number, that gap, to have widened, right? So there's a lot of room for growth in private consumption. And therefore, in China, we focus and only invest in sectors or businesses which cater to private consumption. In India, we do the opposite, because in India, rupee is relatively weak, inflation rate is quite high, and therefore, if you invest in the domestic market, or if you invest in businesses which cater to the domestic market, then you will have to bear the currency risk as well as the inflation risk. But India is a great outsourcing country. You know, a company like Infosys, their income is almost entirely in hard currency, but their cost is in local currency, which is relatively weak. So in India, we focus on the export and outsourcing sector, completely opposite of what we do in China. So in different markets, we do it somewhat differently.
What about any particular type of private consumption in China, like a fashion, retail, food? Is there any particular segment in the private consumption sector?
I would say all of the above. However, China is a market where there's too much capital. There's a lot of capital. If you make money doing something particularly well, everybody else would want to do the same. And pretty soon, your profitability is eroded and it won't be so profitable. So the name of the game, there are two. One is you will have to have some competitive advantage, right? A moat, if you will, or some kind of a barrier to entry to protect you from over-competition. A major competitive advantage is scale. So we invested in the company about 6 years ago by the name of China Music Corporation, CMC. We put in about $60 million. We own about 50% of the company. And then a few years later, we merged the company with QQ Music of Tencent. Now it's called Tencent Music Entertainment, which is listed on New York Stock Exchange with a market cap more than $35 billion, right, in just 6 years. From about $100 million company to $35 billion company. How did we do it? Well, we have 800 million unique monthly subscribers for that business. 800 million. That's more than EU and America population combined. Only in China can you get this kind of scale. And of course, subscription paying $1.50 per month for music is extremely affordable. So the entire China market is your market. So to be successful in China, for any business, you have to attain very large scale. That means you will have to expand very, very quickly, hopefully in a profitable way. And that's where you see winners come out in China.
But at the same time, while there are lots of these private consumption sectors in China, I'm sure political issues could also be a concern, because if you look at the way the government has come out to talk about Tencent and Alibaba, and then adding to that with the sanction and all that from the US, how are you navigating that in light of all these political issues?
Sanctions by the United States is not something that you can hedge against. But since we don't invest in the export sector, we focus only on domestic market, we have not been affected at all. And when it comes to regulation, I think an experienced investor would expect it. For example, a lot of people talk about Ant Financial, how it was pulled at last minute from the largest IPO in history ever. But I was not terribly surprised. I had an experience in Japan back in, let's say, 2010, when overnight the Supreme Court ruled that the interest rate ceiling for consumer finance companies should be lowered from 29.2% to 15%. Overnight, almost half of what you used to be able to charge. And not only that, the court ruled that consumer finance companies will have to implement this rule retroactively for the past 10 years, which means they had to give back whatever excess that they charged to the customers in the past 10 years, which bankrupted all the independent consumer finance companies in Japan, except those affiliated with banks. So if you go to Japan today, you don't find independent consumer finance companies. See, regulators are not really so much concerned about the well-being of one or two firms. They are concerned about two things. One is systemic risk. The other is retail customers. Whether or not retail customers will be protected. And that's why banking is so much licensed, so much regulated. I think that regulators simply were very surprised to see that Ant Financial became as large as most of the so-called systemic risk banks. You see, there are large banks like JP Morgan, the largest in the United States, which are referred to as systemic risk banks because the failure of one of them would bring down the entire system, the entire banking system. And therefore, they're regulated as such with very high capital adequacy requirement, many compliance requirement, and reserve ratio, and so forth. By the time Ant Financial was priced, its market cap was larger than JP Morgan. I think they were just very surprised by that. And we saw this coming. The regulation tightening in China, the shadow banking system was pretty much wiped out in the past 3 years. So I think that you will have to be mindful of regulatory headwinds. And China was somewhat underregulated. It's almost like a Wild West for a long time. I think regulation will become tighter in the future.
Right. And with all these political issues, obviously, there's also another front, which is facing the US. And with the new administration coming in, and obviously, I know the financial secretary, Janet Yellen, is a friend of yours. You've worked together before, and she even wrote the introduction to your book. if there's any advice for her or anything that you think the U.S. would work with China again with your influence and knowing of her.
Janet Yellen was my academic advisor when I was doing my PhD at UC Berkeley. So she wrote the foreword for my book, Out of the Gobi. Very kind of her. She is nominated, and I'm sure she will be confirmed as the Treasury Secretary. And I would not presume to give her any advice. I don't think she will need my advice. But I think she knows, as most people, I think, in the administration, that there's a way to build a mutually beneficial relationship. Last year was, or the year before, was the 40th anniversary of formal diplomatic relationship between China and the United States. For most of those years, the relationship was beneficial. I think Trump was very destructive when it came to that particular relationship. I think that there is, of course, a bipartisan consensus in the United States about the threat of China. But I think the real threat from China is the threat to American economic supremacy, not national security. China doesn't export its ideology, however much we don't agree with it. It doesn't export its political system. It doesn't seek regime change anywhere in the world. So it's not a national security threat, but China's rising, obviously, is a threat to America's economic supremacy. What can you do about it? I don't think you can do much about it. China will continue to grow. And all these measures taken by Trump, the trade war, the technology war, the capital war, the expulsion of the Chinese reporters, of course, China retaliated by expelling American reporters, the closure of the consulate and all that, will not achieve anything. Last year, the Chinese economy went up in dollar terms about 10%, I would say. Officially, it's probably about 2%, but the currency went up 6.5%, right? So if you compute it in terms of US dollars, it went up 8 or 9%. And China's trade surplus, on the other side of the coin, is American trade deficit with China, went up 15% last year from 2017 when Trump first took the office. So his war on trade was abject failure. It didn't narrow the trade deficit, which was the stated objective of his trade war. It actually widened it. So I think that this coming administration is not smarter than that. And they hopefully would pursue a policy that would help American economy actually, as opposed to be destructive to the American economy. Let me give you an example here. There's a lot of things that Americans don't understand about China. One most important thing that Americans don't understand China is how capitalist China is. You and I know that China calls itself socialist, but in fact, it's very capitalist. And China embraced a market economy. And China now is the largest trading nation in the world. And China is the second largest recipient of foreign direct investment in the world, right after the United States. That's how open it is, right? So it's very much a market economy. The private sector accounts for 75% of GDP. But there's one thing that China is very different from the United States, and that is China has focused government expenditure on domestic infrastructure build-up. China now has better airports, better highways, better rail system, and so forth, better bridges throughout the country. Just to give you an example, China has built 35,000 kilometers of high-speed rail system, and that's 22,000 miles. high-speed rail is defined as speeds up to 350 kilometers per hour or 220 miles per hour. How much has America built? None, right? Nothing at all. No high-speed rail system. So if you travel by high-speed rail from Beijing to Shanghai, it takes the fastest train 4 hours and 18 minutes. It costs you about $85. The same distance from Boston to Chicago by the fastest Amtrak train would take you 22 hours. It costs you $120. And that's the difference. So America, in order to maintain its economic supremacy, will have to invest in infrastructure, to avoid spending money on defense budget. China's defense budget is a quarter that of the United States. Maybe at this point has gone up to 1/3. So if America underinvests in infrastructure, it will fall behind. It will lose its economic supremacy. I think the Biden administration gets it and has pledged to build infrastructure to focus on clean energy and so forth. I think that's the right direction.
Great. And now that we are both in Hong Kong, looking at both America and China, and having experienced what we experienced over the past 18 months, like you said earlier, we are almost at the epicenter of a political, trade, financial war. Now that you live in Hong Kong, and I hope Hong Kong remains your main base, where do you see the future locally? Is this still an international financial hub for you to look at investment ideas, to do deals and so forth?
I hope Americans will understand better today the need to bring back the rule of law and social stability, and the need to condemn violence, right? That's what we saw in Hong Kong in 2019. I think Hong Kong is and remains a free society with rule of law, independent judicial system. So I think Hong Kong is the best place to do business. It's best place to live, best place to do business if you want to cover the entire Asia. See, we're based in Hong Kong. We cover entire Asia. And anywhere you go, all the way to Seoul, to Tokyo, to Singapore, it's just 3 or 4 hours away, right, to Shanghai and to Beijing. So it's extremely convenient. And I think the position of Hong Kong as the international financial center is very strong. Actually, last year has become stronger with so many Chinese companies seeking listing on Hong Kong Stock Exchange. I remember in the middle of last year, when I was asked the question about Hong Kong as a financial center, I would tell people that the market size of Hong Kong was $4 trillion. I think by the end of last year, it was already $5 trillion. So I think Hong Kong is the best financial center. In 2019, in the second half, some people in Japan asked whether or not Hong Kong is dead and Japan should replace Hong Kong, or Tokyo should replace Hong Kong as the international financial center in Asia. But Tokyo just doesn't have some qualities that Hong Kong has. In Hong Kong, people speak English. That's a working language, as well as Chinese, of course. And Hong Kong, there's no capital gain tax. And personal income tax is 17.5% at maximum. And in Japan, it's almost 50%. So if you combine all those factors, and biggest factor, of course, is Hong Kong is very close to a very large economy, which is China, which is necessary for a true international financial center. So I think Hong Kong is just irreplaceable as the international financial center. Just to give you some idea, or I think many people here actually are fully aware of this, but many of my Western friends are not so aware of this. When I first started private equity business in 1997, 98, China's GDP was about a quarter that of Japan's. Japan was 4 times as large as China. Today, China is 3 times Japan's GDP. So that's how large the Chinese economy has become. In 98, China's GDP was about 70% larger than Korea. Today is 10 times. In 98, China was 2 times the size of India. Today is 6 times. So Hong Kong, positioned very close to a large, fastest growing G20 country economy, is a financial center whose position cannot be challenged by anybody else.
Last week, I shared email exchanges with you, and we talked about how the market could be entering a bubble territory, especially the stock market. What about right now? Do you, we have been going through the longest bull market since the financial crisis in 2008. Do you see this in the public equity world or in the private equity world? Do you think we're in a bubble and deals are just hard to find, or you're waiting for some great opportunities if things pop?
I look at the stock market. I do think it's very bubblish. And I was thinking it was bubblish even 2 years ago, certainly last year. And as you know, all of us know that in March of last year, the market dropped probably by about 30%. And I thought that was probably in reaction to the fact that the economy was going to go into a very difficult period of time, right? Induced by the lockdowns. So there's no question about it. If you look at different metrics, different measures, like PE multiples, like EBITDA multiples, the market is at a very high level. Having said that, however, you sent me the article by Jeremy Grantham. Yeah. And I agree with him. But to call the timing is almost impossible. He said in his article that he called bubbles several times in his career. At only one time, his timing was more or less right. And the other times, he was 2 or 3 years off. Now, if you're 2 or 3 years off, basically you didn't call anything. If you think about it, the market goes up 30% in 2 years. If you stay out of the market, then after 2 years, the market drops 30%. You're not better off, right? So this is something that is very difficult to call. And at this particular moment, we know that money is extremely loose. Interest rate is about 0. And we know that every country is unleashing stimulus package. And in the United States, the Biden administration, to be installed, is already talking about another $2 trillion of stimulus. So under the circumstances, we know there's a bubble. We just don't know when the bubble will burst and how long the bubble will continue. And I would say that maybe this is not time to leverage your bet on the stock market. But who knows when will be a good time for you to get out completely.
Your new book, Money Games, your book on how you, back in the 90s, rescued a Korean bank. Could you kind of tell me more about how that book came about and what we can learn from it?
The book is a story about Newbridge Capital acquiring control of what used to be the largest bank in Korea, which failed during the last Asian financial crisis of 97, 98, and it was nationalized by the Korean government. And then the Korean government was almost forced to sell the bank to a foreign investor because Korea was in dire strait at that time as a result of the Asian financial crisis. Its stock market, for example, in 1997, dropped 49%. Almost half of its value was wiped out. Its currency, Korean won, declined by 65.9%. Two-thirds of its value was wiped out. Korea's foreign exchange reserves came down to $8.9 billion. Now, remember, Korea is the 10th largest economy in the world. Its foreign exchange reserves came down to $8.9 billion. My firm manages $40 billion. So you can see that Korea was running out of money to meet its foreign obligations. It was under those circumstances that IMF came in with a rescue package of $48 billion, but with the condition that Korea had to sell 2 nationalized banks to foreign investors on the ground that there was a lack of credit culture in Korea, and therefore it had to be brought from abroad. And that's how we got into the picture. And the book describes the entire saga from very beginning of negotiating with the Korean government to taking over that bank, turning around that institution, and eventually selling the bank. Now, there were some books on private equity, like Barbarians at the Gate. I'm sure many people have read it. But almost, I think all of those books were written by outsiders, by reporters, dealing only with the deal-making part of the deal. And that, for example, Barbarians at the Gate was written in 1989, 1 year after the RJR Nabisco deal was put together by KKR and by 2 Wall Street reporters. So the book only dealt with the deal-making part of the transaction. Henry Kravis of KKR likes to say that any idiot can buy a business. It is what happens to a business afterwards that really matters. And there's no book that I could find that deals with the entire investment cycle for a private equity transaction. That is from investing to turning around the institution and eventually exiting. And you and I know without exit, no deal can be considered to be a good deal. So this book is quite unique, a fill a void in my view, by describing the entire cycle of a major private equity transaction.
What about the skill sets between the West and the East? Obviously, in the 90s, you were with a Western private equity firm, and maybe the Western, skill set and expertise were essential in rescuing the Korean bank. But right now, with the expertise that you have and the talent in Asia, do you think one day we could even, from Asia, rescuing Western banks, or maybe PAG doing something beyond Asia?
Absolutely. In fact, back, let's say 2000, private equity was already a very established, very developed industry. And, KKR's RJR Nabisco deal was done in 1988, right? At the time, I think private equity was almost unheard of. I described in my book that when I first interviewed with David Bonderman of TPG back in 1997, he immediately was able to tell that I was clueless about private equity. I actually didn't know anything about private equity. He hired me anyway for reasons I describe in my book, so you can check it out. But at the time, private equity was very much unknown. And I joined Newbridge Capital, and I was co-managing partner, and we managed just about $100 million. And that was a big deal, $100 million. Today, we don't invest in any deal less than $100 million per deal, right? And we manage tens of billions of dollars. So it's very different now. I would say that private equity is not rocket science. And it's not so difficult to figure it out. At this particular point, I think the most experienced private equity firms in Asia are probably as good, maybe even better than their Western counterparts. So there's no reason why firms based here in Asia, in Hong Kong, cannot do big deals in markets like America and in Europe. Actually, we have done some deals I will not get into here.
For the audience, Shan has published this new book, The Money Games. If you have not read it, feel free to read it. And if you want an autograph copy, maybe I could get a hold of Shan and get some autograph copies. So once again, thank you so much for spending time with us today and sharing your outlook as well as your book writing journey. Let's keep in touch. Thank you so much, Shan.
Thank you. Thank you very much.
Thank you. Bye-bye.